Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're going to be analyzing Cummins stock. Happy New Year to everybody. I took it a little bit easy and only put out a handful of videos over the past couple weeks of holidays, but I should be back on my mostly daily schedule here. If you have a request for a video analysis, just put it down in the comments and I'll get it on the whiteboard behind me. And eventually I'll make an analysis video. And the stocks that are in the S&P 500, I put those on YouTube for free. The rest I put on Patreon, which is $5 a month. And if you join Patreon, you get a big discount to the full Cyclical Investors Club service over on Seeking Alpha, where I have all the spreadsheets you see me using here, chat room, you can chat with me, send me messages. I have, dozens and dozens of articles that aren't put out to the public that are there, and you get all the explanations of all my strategies, everything that I'm holding, everything that I ever have held. Consider joining there, and those links will be down in the description. As always, this is not individual investing advice. This is just how I personally analyze stocks. So we had a request for Cummins. I always like to review kind of any kind of coverage that I've had. I haven't written on Cummins in a long time. I did own it. I caught a little bit of this bounce, I think, in 2019, early 2019 or late 2019 going into 2019. I did warn about it at the right near the peak here in 2018. But it never really got super cheap. So I think I sold it for like a 25% gain or something after a few months. So I've never captured like a full cycle. It was more of kind of I got into it a little bit on the way up after kind of a mild down cycle that we had in 2018. I always like to check the earnings cyclicality. Cummins is a little bit weird in that respect. I don't have it go. I think they might have been more cyclical. When I first started covering them, FastGraphs puts out 20 years of data. So I used to have data from the 2000 decline, and I think it was a little bit more, earnings were more cyclical then. But since then, earnings have actually only been, I would say, moderately cyclical. In terms of adjusted earnings, let me shorten this a little bit. So yeah, I mean, that 50% is kind of my rough threshold. They fell almost 40% in 2009, and then kind of a moderate downturn here, another moderate one here, and then COVID, we can explain that one away a little bit before a quick recovery. So the thing is, though, I treat it as a deep cyclical business. One, because I know it's an industrial business, and usually they're more cyclical just generally. So it kind of tilts me that way. But also because the stock price is actually pretty deeply cyclical. This decline, I think, during the Great Recession was more than 70% for the price. I'll look at this in a minute. This one was around 50% during the industrial recession. And then I think we got close to that here, but not quite. And again, so you can see the price is pretty much a deep cyclical price movement. So that's how I trade it. Even when the earnings move this much, they aren't a very good sort of measure of the stock value. Also, they can be, if you bought right before the Great Recession, it's not like you would have been paying like a high PE, but when the earnings fall, the stock, even if you bought this dip, let's say, and you only paid an 11 PE, in the Great Recession, you still would have lost something like, and this will be not the perfect bottom, but you still would have lost 55%. So I don't think earnings are the best way. You could try to do it, but probably not the best way. And it always usually trades at a pretty big discount to the market because the market treats it as a cyclical. So for me, it goes in the deep cyclical category, even though you could make the case that the earnings are just kind of moderately deep, kind of on the edge. So that's how I think about it. When you back it up, I think maybe it's because we back up here, it makes it look so out of whack there. If we shorten it, kind of, you can see that the price does kind of roughly correlate with earnings, but usually the price will move before earnings. So this is another important thing about cyclicals. So if you look at, and this is what I think can get people into trouble, is the earnings usually are moving like a year after the price. So the market is anticipating what's happening like a year in advance. So before this decline, even starting here, you started to see the weakness. It had a little bump briefly, but you really saw the weakness before that decline. You started to see the weakness of this 2 years decline a full year before. And before this steeper decline, you saw the price moving again about a year before. So that's something to keep in mind, and why another reason why it's a good idea maybe to treat this one as a deep cyclical. We don't want the market's going to anticipate these, even if they're moderate future earnings declines. So you don't want to be really holding these. Preferably, you would have done fine probably with this particular one because it's so high quality. I mean, if you bought it at the peak before the Great Recession, you still could have got 10% returns. But I mean, over this time, if you just held, but you would have had to just really put up with a lot of volatility, and it's not the ideal way. I mean, a good investor. I wasn't cyclical investing back here. I didn't really start until 2015, and then it didn't quite get to my levels here, but if you hit this and you just bought when it was 50% off its highs and doubled, you could have gotten one double, two doubles. I think this one was maybe just short of a double, just short. So that 2018 peak is probably why I didn't buy it. It was 194 and then it bottomed, it looks like, at 101. So that's like a 45, we'll call it 45% decline instead of 50. So you could have gotten two doubles, and then your money would have been free for the vast majority of this time to put it somewhere else. And you could have captured, I don't know what all those gains were. Let's see what the total gain was. So you would have captured the same amount as a buy and hold, only you would have had to hold it 4 years out of the last 14 or something like that. So that's the benefit of taking advantage of the cycles, especially if you have a lot of different stocks like I do that I could potentially buy. I'm not just locked into this one. A lot of times people get locked into one stock. I'll take whatever the market gives me as long as the quality's there. I will say when I reviewed this one, I did decide to take a little bit different approach than I had been previously, which I think I was aiming for a 60% decline before I would consider buying. Obviously, I mean, some of these things go without saying, but I'll review it out loud. The earnings trend is exactly what you want to see with a cyclical stock: higher highs, higher lows, higher peaks each time. I mean, it's almost perfect in that regard. Where it's not quite as perfect is it's just because it's been so quality, basically, the declines haven't been quite as deep as I would like, and that's stopped me from being able to really get in at these kind of bottoms. And we haven't had a recession like 2008 since then too, so we haven't seen like the deep decline. We've only seen kind of the moderate, I call them mid-cycle declines, which is kind of what this was. So we have the quality here. The question really is, when's a good time, or what's a method to use to step in and buy? So for cyclicals, I try to buy at a certain percentage off the high, assuming a bunch of other things are true. We know the quality's here. There isn't really, you might make the case that this is a super cycle. I think it is a little exaggerated here because of the big graph. I don't think it really is. I mean, this isn't that much higher than the 20, and granted, it's like 4 years later than the 2018 peak, or 3 years later. So it's a solid upcycle. You want to be careful with super cycles. I don't think I would consider this one a super cycle. I would just consider it a normal upcycle with the COVID stuff, mixed in. So I don't think we need to worry about that. It's really just a question of how far off the highs using the price do we want to consider buying it? And it makes sense with these to just kind of not look at the earnings once we establish they're cyclical, and we can get a better read on these price movements. And let's go to the spreadsheet because I wrote these down. So, oh, maybe I didn't. Yeah, I did. Okay, so here's our drawdowns. 2001 drawdown, we have a 60% drawdown, and I think earnings were actually deeply cyclical there then too, even though the fast graph isn't now going back that far. 2008, we're looking at a 69% drawdown. So if you just looked at these two recessions, you could say we probably expect it to roughly fall 65% during a recession. And then 2020 was a 46% decline. And then that 2015, I think this is from 2015, was more like a 45% is what I'm thinking here, or what we would expect. So before, I think I had I would buy it at a 60% drawdown. That's where I was setting at because I thought, we have a recession, we'll pick it up. That gives a little cushion. You're not trying to exactly pick the bottom. You're just trying to kind of get close. But since I've been missing it every downturn, and they do have pretty significant history of falling in that kind of 45 to 50% range, but not quite getting to that 50%. What I've decided to do here is set up two buy prices. So I don't always do this, but sometimes, often with semiconductors that can have these really big cycles, I have an initial buy price, and then if things really go south, usually it's when a confluence of things come together. So maybe there's already one sort of problem with industrial demand, maybe like we have now, and then on top of that we have a recession, and that's when you get that super deep drawdown. Both of those are possible with these type of stocks, but you can't really predict what type of one it's going to be ahead of time. So in those cases, which is the change that I've made here, I will say, okay, I'll buy at two different points. I'll buy when the price is 45% off the high. That gives a chance to capture some of these cycles that happen every 3 to 5 years lately. And then in the back of our mind, we will also say, but we know that it could fall 65%. So we're willing to come in because Cummins is so high quality. We know they'll probably eventually recover, or at least there's a high probability of that. If we do end up getting that 65% decline, we'll come in with another 1% weighted purchase, and then you'll have a double position somewhere between it'd be 55% off the high. So you'd have a good potential gain in front of you, and I've done this before with other stocks, and usually it works pretty well. Albemarle is one off the top of my head. I did the exact same thing. So that 45% price drawdown is 152.40. That's where I would look to make the first 1% weighted purchase. And then if we ever actually get that, I'll put in the deeper one here, and then I'll buy there. And this price will remain good until we get a new high. So what you would want to watch for, we're still, what are we at, 239? The old high is 277. So if it went above 277, that would adjust that buy price up higher. We'd have a new peak we were drawing down from. And that's how I would go about doing it. And then usually the recovery period for Cummins is usually not particularly long. Even if you would have bought here, you would have been recovered in 2 years. That's really short. This one, again, about 2 years to meet your goal. If you manage to pick this up, kind of depends on if you took profits here or not. If you didn't, you would have had to wait 3 years. 2 or 3 years, that's solid for, we'll call it a 75 to 100% gain on a 45% decline. And then obviously deeper if you get that deeper buy. So that would be the strategy that I would use. I would just ignore earnings with this one, watch for the highs, and measure down off that and try to pick up these dips. Because if you buy this dip, if you bought that dip, either one of these two, you would be doing just fine. And then you could put your money somewhere else when Cummins isn't at a great price. All right, thanks for watching. If you found this useful, hit the subscribe button, and I'll see everybody later. Bye.